down 69% in 2022. Is NIO stock a buy for 2023? I'm going to answer that question in this video, so stay tuned. The first thing I'm going to look at here is quarterly revenue growth for NIO. We don't have very much data for NIO, but it's the few quarters of data that we have shows the company's been growing about 25% year over year on a quarterly basis. So nice steady growth from NIO here, the electric vehicle company. So since it's growing very nicely on the top line, I would like to see some growth in operating income, which we're not seeing here. In fact, as the quarters go on, NIO is losing more and more money on the bottom line. Operating income is falling in the wrong direction and escalating to a loss of $565 million in operating income in its most recent quarter. The next thing I want to look at is NIO's cash flow from operations, because some companies, tech companies and some manufacturing companies do have a lot of expenses that are non-cash in nature, like stock-based compensation, which is a non-cash expense, and depreciation, which is also a non-cash expense. So operating profitability may look worse than cash flow from operations, and that is the case for NIO here. If you look at its cash flow from operations, it was actually positive 51.86 million, even though its operating income was negative 565 million. This tells me the company has a lot of non-cash expenses. Since it's an electric vehicle company, I'm assuming this is a lot of depreciation and amortization, along with some stock-based compensation in there as well. And so it's a good sign to see cash flow from operations is rising, even though operating income is falling. Ideally, I'd like to see both of these metrics moving upward, but at least if it can't have operating profitability moving in the positive direction, at least it has cash flow from operations moving in the positive direction. All right. Finally, to determine if the stock is a buy, we have to use the price to, well, I shouldn't say have to, but I chose to use the price to sales ratio because the company is not delivering profitability consistently on the bottom line, so I couldn't use the price to earnings ratio. It's also not consistently delivering cash flow from operations or free cash flow, so I chose not to use the price to free cash flow. So one of the few options I had left was the price to sales ratio. I chose to use this one to simplify matters. And looking at this metric, it is trading at a price to sales of 2.394, which is just about the same price it was trading for before the onset of the pandemic. Where during the pandemic it exploded to trading at a price to sales above 30. And if you recall, during the earlier stages of the pandemic, EV stocks were some of the most hottest stocks to buy. They were, in my opinion, irrationally bid upwards of these kinds of valuations. It wasn't just NIO, it was Tesla, it was Polestar, it was Rivian, it was Lucid. All of the EV stocks, they got really popular. Investors just poured into them. They thought the world was going to switch to EVs overnight, and in the next 3 weeks everyone was going to drive an electric vehicle, and these companies were going to get billions of dollars in profits. And there was a lot of this rosy expectations for these companies, not considering how difficult it is to ramp up manufacturing from starting from scratch and building out a entirely new car company, let alone building out an entirely new car company on new technology, right? Electric technology is new, and what NIO is doing is also unique in that it's not doing charging stations, it's doing replacement batteries, so it's shortening the time from charging. So that's going to be a little bit different from, Tesla and Rivian and some of the other ones. So it's new technology, ramping up new manufacturing, all of that. That's really difficult and challenging to do, and valuation, in my opinion, should never have gotten that high. 2.4 is more realistic. It's more at the level it was before the outbreak, right? This is where it was before all the hype it was trading at 2.4, so it's back to its normal levels. So I know some investors might be saying, oh, the stock is so cheap now because it fell so much, and now is the time to buy because it's so cheap. I would say hold your horses. Just because the stock is down 70% doesn't make it cheap. It just means it's back down to levels where it should have been to begin with. It should never have risen so much to begin with. So with all of the macroeconomic headwinds facing vehicle manufacturers in 2023 and the potential onset of a worldwide economic recession, I would say NIO stock is not a buy for 2023. Okay, so that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.